ago. And we're working together. And so one day my mom was sitting there and she said, well, why don't we reach out to our community of families with special needs? Because of everything that I did for my son, Jonah. And I'll explain to that in a second. Jonah has been going to summer camp for 7 years now. And I know that because he got a sweatshirt 2 years ago, his 5-year sweatshirt. And summer camp, I'd like to thank you so much for giving us this opportunity to speak. And I think we can share a lot of knowledge with you guys. So I'd like to start out with a little story of how Jonah wound up at summer camp. And I explained this to Thea just a few minutes ago. First year, when Jonah went to camp at 8 years old, he went to Camp Round Lake. And in 24 hours, Jonah got kicked out of camp. So the next year, when I found summer camp through a friend of ours, and this was Shep's first year, I said, Shep, whatever you do, you can't kick Jonah out of camp, because you can imagine how traumatic that was in the first year. Shep promised me and promised me and promised me until finally he said, Howie, you got to leave me alone. And so I did leave him alone. Jonah loves camp there, and he's been going to Summit ever since. I think this is his 7th year. It might be his 8th year. And what I want to share with you guys is what I did for Jonah 5 years ago and how important it was and why it's important. So I'll start with my presentation. Okay. And so the first thing that I think you need to think about, and every child is different. Now, we've all been to Summit, and there's the full gamut of children at Summit. And you want to think about the expectations for your child. Now, if you think that your son or daughter is going to be working full-time and be fully independent, probably you'll get a lot out of this presentation, but I would expect that most of it you don't need to prepare for. And in the case of Jonah and some of the other people we've worked with, you need to prepare. And because the government will provide certain aid and support to live independently and financially. But if you don't prepare for that, the support goes away very fast. And I learned that and started to prepare for that about 5 years ago. So will they be working full time? Will they be living independently? Will they have health insurance? And will your son or daughter qualify for government aid? So that's first questions. And then you sort of want to think about, well, what is going to be the income and the expenses for your child? So the income is obviously earned income, wherever they're going to work. Unearned income would be gifts, investment income. And then the government portion of this is the SSI and Medicare. So, and Medicaid, I'm sorry. So the Medicaid usually comes, you'll see later, it comes, if you get SSI, in most states, you automatically get Medicaid, and that's going to be your health care. Your expenses are going to be your medical needs, housing needs, education. Most of this is pretty self-explanatory, but just important to think about. Everyone's in their own unique situation. And I know for me, it wasn't first and foremost when I figured out that, what Jonah had to go through and what the plans were for him. So the government programs for Social Security and Medicaid, these are what the government will pay. For an individual, monthly, it's $914. And at 18 years old, pretty much your son or daughter will be considered an adult, and they won't be relying on your income or your assets to determine whether or not they're going to get government programs. I'm going to take a couple second steps back because I want to summarize something to make it clear. If you don't take preparations early, what'll happen is the government will see the assets that you have or that your son or daughter has, and you won't qualify for any of these government programs. So part of what the process and the setup and the structure is, which we're going to get through in a little bit, is that if you prepare and set up accounts properly, well, then they'll always qualify, and that won't be a problem. So you want them to, and the government gives you ways to shelter. I don't want to use the word hide, but put money in different categories and different places so that it's not in their name. So once it becomes in their name, they lose their aid and their social security, they lose their SSI and they'll lose their health care immediately. So I'll go on to explain that. So here are some of the disqualifications. Good thing I said that. So if your son or daughter has $2,000 in a bank account for an individual, they no longer qualify for Social Security or Medicaid. If they're a couple, if it's a married couple, it's $3,000. So that would be later on in the future. But if it's $3,000 per couple, then you have gifts or pension income. So if they had gift income or pension income, if they have greater than $934 a month, it also disqualifies them. And then for the couple, it's $1,391. For wages, you'll see wages $1,913 per month, very specific, and greater than $2,827 per month for a couple. So what this is saying is that if your son or daughter has money put away in their own name, in a bank account, in an investment account, $2,000, they won't get the aid that they're entitled to. If they earn more than $1,913 per month, they also won't get the aid. But that's great though. If they're earning lots of money, well, great. They don't need the aid. So that's a great thing. There's a 36-month look back period. So that's why I say it's important to start early, because if you don't start early, they're going to go back 3 years. So at year 8, when they're 18, they're going to go back to when they were 15 and look at the money they had at that point. So that's important. And if they have money in their own account now, you have to think about how to get that transferred into these other accounts that I'm going to explain in a second, what you're able to set up. And you have to start that even earlier. You can get it out of their name and you can move that into these other accounts, which is still their accounts. It's just not technically in their name. So here's the summary to-do list that I set up. So you want to create an ABLE account. Now I'm going to go ahead and explain all of these later. And you want to create a special needs trust, depending on the number of assets and how much assets your son or daughter have in their name or will have in their name. You want to move assets out of your child's name, which is what I explained a second ago. So if they have assets now and they're 4, 5, 7, 10 years old, you have a few years to do that. You can start moving. Things like Summit Camp is a good way to do that, actually. So if you pay for Summit Camp, and that's X thousands of dollars, you could then take the money out of the child's name, and you can put that into your own account and then sort of move that into a trust. And I can explain that later in more detail. So the next thing there is that if anyone, grandparents, aunts, uncles, have money that they plan to leave to the child, you want to make sure that once a trust is set up, you want to leave it to the trust, because 5, 10 years down the road, if your child is receiving benefits from the state, all of a sudden Aunt Millie, let's say, and Uncle Willie left them $10,000, they're now going to lose their benefits. So you would want to, the beneficiary would be the trust. So step 3 is you'd want to purchase life insurance for key caregivers, for reasons that if the caregiver is no longer there, that you'd want to be able to replace that care. And so the child, well, no longer a child at that point, probably has special care at that point. And then step 4 is easy, invest in easy for us, but invest your assets wisely. Invest it in things that are going to grow and be safe once it's in a trust. So support team, this is all part of setting up the plan. You know, the loved ones and the caregivers, most important, because everything else comes from that. Financial advisor for advice and ongoing support, to trustees, to your child, to you. You'll need if we set up a trust at some point, if you decide to set up a trust, you'll need a special needs attorney. That can range anywhere from $2,500 to $10,000, depending on your assets and the structures. That's a one-time initial setup. Insurance professional, depending on how detailed the insurance goes, but if you just have basic term insurance, usually a financial advisor could do that. If something more complicated, you'd bring in an insurance professional. Okay, an ABLE account. So in case you guys have not, what's that? In case you guys haven't, don't know what an ABLE account is. An ABLE account was signed into law by Barack Obama. I thank him for that. Some people may not be thanking him for very much, but I won't get into politics. With the crazy politics now, he actually seems like a great politician. But so he created an ABLE account, he signed it into law. And what that gives your child is up to $100,000 for your child. Can have it's almost like a bank account, but this ABLE account allows them to have these assets where obviously it's greater than $2,000. They can then keep these assets in the ABLE account up to $100,000. And I'll explain how you get the money in there in a second. And they can use, they have a debit card, they have a checking card, it's their own bank account. You can invest it, part of it. Most of the investments are in mutual funds. So there's two sections of it. There's like the checking and banking, and then there's a mutual and investment funds. And so you can, the child can put your money in his money or her money into that. So if there's assets in their name, you want to move that out and move it into the ABLE account. Once you open it, it's really easy to open an ABLE account. I'll explain that in a different slide. And then anyone can donate to the ABLE account. Anyone can contribute. It could be you, it could be an uncle, it could be, it could actually later on, do I even have this on a slide? It can later on, it could be even work. So when your child does get a job and they get, they're making $500, $1,000 a month, that money can be direct deposited into the ABLE account. So that's useful. So then it doesn't go into their own name, and then they won't lose their benefits. So it was good. It was encouraging, like I said in the slide here, encouraging disabled individuals to work and save. The individual must have a diagnosis before 26 years old. And most of us probably have that. So the pros and cons of an ABLE account, up to 100,000. You can't go over 100,000. Once you go over 100,000, then you will lose your government programs. So it does have a checking account, like I said, a debit account, employee direct deposit, employment direct deposit. You can have a $17,000 annual contribution, and you can spend on things like housing, and you can spend on cars, and you can use it for almost anything. And then you can contribute more, up to $17,000 per year. Additional $13,000. You guys will all get a copy of this presentation, so these numbers just will come later. You can review them. Additional $13,590 allowed from work. So they can put in, you can put in up to $30,950 per year, which can be obviously used on expenses for your child. The cool part is that all of it grows tax-free. So I said there's a checking account part, and then there is an investment part of it. So the investment part is mostly mutual funds, which to me is a little bit not as exciting, but still safe. And the mutual funds will grow tax-free as long as you're using it for the purposes of qualified disability expenses. So that's pretty cool. So there won't no taxes on those gains. Here allowed uses: housing, food, legal fees, health, wellness. 529 rollover accounts. I won't go too much into that, but if you have another son or daughter that had money you didn't spending on college, you can roll over a 529 from one sibling to another. So you can move it into the ABLE account. That's pretty cool. The cons is $100,000 limit, limited to mutual fund investments. No beneficiaries allowed. So at the end, when your child lives a very healthy, long life, you can't deposit, that can't be left to his children, her children, or someone else. The remaining funds are used to pay back Medicaid and Social Security. So whatever's left in that account. Setup is easy. Again, you'll have these links. Requires disability certification by a doctor. It is valid in most states. You don't have to be in the state where you open your ABLE account. So you can You can, if you use this list here and you can compare the states, you can open in Alabama. It won't matter. It's all digital. If that's the best state, I'm just using that as an example. If not in your state, you can use a plan in another state. So in addition to an ABLE account, that might be satisfactory for a whole group of parents and not required to do much more than that. But for somebody that had a lot of assets, maybe in your child's name, maybe received some kind of inheritance or had money put away for years, you'd want to create a special needs trust. And a special needs trust has no contribution limits. The assets are not in the beneficiary's name. So it's not in the name of your child, it's in the name of the trust. So the assets don't disqualify from government programs. And this is what we need a special attorney to set up, a special needs attorney to set up. Like I said, about 2,500 to 10,000, depending on how complicated it is. And then from a special needs trust, there's many investment options. You can invest directly in securities, you can invest in bonds, real estate, insurance, and more. Trustee is in charge. That's part of a con. So you don't have, but the parent can be a trustee, so that's fine. And you could have control over the assets. And there's legal fees to set it up. And there are two types of special needs trusts. There's a first party and a third party trust. Now, a first party trust would be in your child's name, and the trust would then be funded by your child's fund. So let's say, for example, your child had $200,000 in the bank account that you needed to put away so they could qualify for government programs. You couldn't really move that to a third-party trust. They would be funding it themselves. The trust is funded by the individual, by the disabled individual, and then it's moved into that trust, and all that money's in there. It's out of the trust name. The con is that upon death, the remaining funds are again here used to pay back Social Security and Medicaid. So you can't, there's no beneficiaries on that. The trust is that money is used to pay back the state. A third party trust can be funded by anyone. So that would be your parents, your grandparents, Uncle Willie, and upon death, there is beneficiaries, and the remaining funds will be distributed to the beneficiaries of that individual, children, sisters, brothers, cousins. So that's a third party trust. Either way, this sort of takes the money out of the disabled child's name, and allows them to get the state funded SSI and healthcare for as long as needed. So there's a revocable and irrevocable trust. So revocable would be that the trust can be changed by the person that created the trust, and the assets are included. I won't go into too much detail on this, but the assets are included in the person who created the trust estate, so that upon, when whoever created the trust, say it was a grandparent, they could change it, but when that grandparent passes, the assets are then just become part of the grandparent's estate and are subject to federal taxation. And it only becomes a problem when you start going over the limits, federal tax limits, and that's where you would probably decide to do an irrevocable trust so that you can get it out of someone's estate. So if it says here, it says useful if the grantor has significant assets beyond the expected estate tax limits. If there was $20 million, $30 million, right now I believe it's 26 million per couple. Is that what it is? I think it's 12 or 13 million per individual. So if we're talking very large millions of dollars, you'd want to do an irrevocable trust. You would get it out of your estate. And then upon death of that individual, it's not taxed at the federal level anymore. It's out of the person's estate. It also provides protections from creditors. We're going to assume here that most of this group is not being chased by creditors. We're all good people. Okay. So the trustee of the trust is someone obviously that you trust very much. Is familiar with the needs and the routines of the individual. Someone that cares about the individual, and hopefully has knowledge of public benefits or would use a professional who does have that knowledge. You can have a co-trustee and you can have a professional trustee, but the negative of that is that there is a fee to manage that. We work for Wells Fargo. We have our own independent office within Wells Fargo. Wells Fargo does offer most of those trust services, so that if it ever came to that and you didn't have a trustee, we do have that service available. Life insurance. We want to ensure the financial replacement of the caregivers. This is step 3. So you want to make sure that whoever the caregivers are, that should they no longer be around, that there's insurance that could pay for the replacement of the caregiver, grandparent, sibling, other, all of the above. Life insurance is a tax-free source of funding. So life insurance, when you receive life insurance benefit, there's no taxes on that. So that's pretty useful, and it will go right to pay for the services or whoever was hired to take the place. Term life insurance usually works. You could have other options that get more complicated, and in which case we would bring in more professional insurance people. You have variable life insurance, variable universal life insurance, where it grows with the market. But if you had the right number in term, it's probably good enough. And the least expensive. Thank you. The third party trust. So here, what's important about the life insurance is that the insured owns the policy, and the beneficiary, again, like we said with inheritance, names the third party trust or as the beneficiary. Because again, if the money for the life insurance goes to the individual, well, they lose their benefits again. So once you lose your benefits, it becomes years of fighting. I didn't get this to try to get your benefits back, because you have to prove, first of all, you have to get all that money out of your name, and then you have to figure out how to get it back from the state. All right. We got to the end. So I see there's some questions. This is us. This is myself and Gail. If you ever needed to contact us about any questions you have. So what I've done is we've set up a team. I'm working with the team to provide the legal advice and also provide the insurance advice and the financial advice. So we are available anytime, all the time, with any questions. Any questions we can't answer, we will find resources to answer them for you, and we will get back to you on that. And that is what we
contact them within your state.
Yes, we can contact people within your state to find people. So I guess we should go to the questions, and I should probably read them here. Okay. Thea, should I be answering these questions through this? There we go.
So yeah, do you want me to read off the questions and then you answer?
Sure. I guess we can start
Okay.
here. Go ahead.
Sure. All right. So Susan Montes asked, William's mom, hi. If a child has a New York Able account with $200,000, can a child have another checking account with under $200,000?
Well,
if you need to read it, scroll up. It's
right. I think you wanted to make sure. Okay, so the Able account should only have 100,000. The limit's 100,000, and you can only have one. It doesn't matter with the state. You can only have one. I think that answered the question.
okay. And guys, if we're reading your question and you want more elaboration, you want to ask another question, just unmute yourself and put your video on. You can ask Howard yourself. Okay, so Karen wants to know if the child has a 529 college account in his name, but the money has not been withdrawn. Will that count as income by the state?
So what you'll do with the 529 is you can roll that into an Able account. So if you don't use it, I think that's where the question is. So if you don't use it, you'll roll it into the Able account at that point. If it is, yeah, I don't think that'll count. I'm gonna have to check if it'll qualify if you keep it there. If you don't create an Able account, I would probably suggest using an Able account unless you're talking about numbers that go beyond 100,000. So I would max out the Able account before you go into a 529 is probably what I would. So
Okay.
if it's already in the 529, depending how old your child is, you probably we would roll that into an ABLE account.
Good answer. Speaking of age, Sandra asks, so for those of us that didn't know if we open ABLE accounts, et cetera, at age 17, oh, so she has her child is age 17 and they have not opened an ABLE account. Then
Okay.
should we wait until that they are 21 to apply for SSI, given the 36-month look back? Am I understanding my huge mistake?
So yeah, well, there's no reason to apply if you have the assets. So if there's assets in the child's name, what you want to do, you want to wait 3 years. The first thing you want to do is you can move, if it's less than 100,000, you would move into an ABLE account, and then you could, I'll check if you can apply, but I think you'd probably be spinning your wheels. But I will double check that, because there's a 36-month look back. You could always cross your fingers, I guess. If it's more than 100,000 and you would want to move 50 or so into an ABLE account, and then you would want to create a first party trust, special needs trust, where you'd put the rest in that. Because an ABLE account, you're going to keep putting more and more in every year probably. So if you have more than 100,000, you put into a special needs trust, and that would shelter it. And to answer your question, you'd probably then wait 36 months. Yeah, so probably you probably would have to wait 3 years. You're 17, so yes, 20.
Okay. Great.
But you want to start as soon as possible. So
early start. Carrie, Tyler's mom, is asking SSDI versus ticket to work / workability. What are your thoughts?
Ticket to work. I am not familiar with ticket to work. Ticket to work. I don't. To go to work or ticket to work.
Carrie, maybe you can send us a link or something to it.
Ticket to work. I'm
Yeah,
not familiar
just-
with it.
if you after a couple of years of working in SSI, you eventually qualify, you get kind of put into SSDI,
Right.
and then you're able to make a little bit more money. But if you make too much money, then they want you to enroll in ticket to work, which is, I just was seeing if you knew, like, I'm kind of going through that right now, and I wanted to see if you knew anything about it, but it's okay if
I don't. Well, what I'll do is I'll look into it, and
Okay.
if you could email me, and I'll get you all the information that I can find out. So,
it's another overwhelming layer to the whole thing. So
well, I'm learning. I've learned what I know, and then I'm learning more and more. So
it
I
never
wanna be
ends. Thank you.
I know that Carrie's been jumping through the hoops for many years. Tyler's been traveling with me for some years, and he has a superwoman mom, and he works at an awesome place, and he's awesome. Okay, so Laura Stolman says, this has concerned me about ABLE accounts. The ABLE Act provides that after death of the account owner, designated beneficiary, the state Medicaid program has a repayment right.
Yes, that's for sure. So there's no beneficiaries on that, and there's no beneficiaries on a first party trust either. Well, depending on how much is in there, because you have to repay what the government lends you if you have money. So yes, but I would preface that by saying, you'll be able to spend it on housing and cars and medical expenses. So, it's not going to be that hard to spend it, but yes. So you can use it on things.
All right, Gabriella says, my son is 15 and has money in a 529. Can I move it into an ABLE and it not count as a part of the 3-year look back?
Yes, that's part of the 3-year look back. I'm going to check that 3-year look back on the ABLE on the 529. I'm not 100% sure of that. That might be part of the look back, because it was in. I have to see how the government looks at 529 plans, but I think the 529 plan is in the child's name, so I would think that you would not be able. That would be part of the look back.
Can I just, because I did go through this too, sorry.
Okay. Great.
I don't want to school you, but what we were told was the 529 is in the name of the account owner, which be whoever opened it up. So
that's true. That's true.
We opened, like my husband opened up our 529, so he's considered the account owner. Tyler is the beneficiary of it. So it does not count towards.
That
your
would make
asset.
sense. I appreciate that. That would
Yeah.
make absolute sense because all 529 plans are open in the account owner end. That's exactly right. So
Yeah.
that makes a lot of sense.
So you
So
can
then-
keep it as is, and we've held it open. Social Security didn't care, and then we're just siphoning it over to our, his sibling.
Right, or you could roll that into the able account, either way.
Yeah.
Yeah. Yeah, that's fine. You can roll, 529s can be rolled between siblings, between most family members. If they're not used.
That's great. We're glad you're here, Carrie. That's what this is all about, is everybody sharing
Yeah,
information.
that was awesome. Thank you.
I'm just the great connector. I don't know any of this stuff. Okay, Michelle wants to know, can I use the ABLE and or the 529 to pay for vocational/educational programs like Summit Camp and Travel and the Summit Center?
Absolutely. Yes, absolutely. 100%. So right away, you can use your ABLE account. It's gonna go down pretty fast.
Karen wants to know, does the trustee need to be someone who is likely to live as long as the disabled person? What happens if the trustee is much older than the disabled person?
Yeah, you have to get another trustee at that point. So my partner's gonna come in for a second. Hold on, let me put on mute.
Okay, sometime what would be advantageous is if you're using an attorney or an accountant, that there's a group practice. So that if one is really older and retires, there's a backup. Very often, you don't want a sibling to be the trustee because then that creates tremendous pressure on them. So they'll use an outside service. And your special needs attorney usually can set you up with someone who would be the trustee or a group, an organization, be it an accounting firm or a legal firm, so that almost like a bank does that, be it Wells Fargo or any bank, they have trust services. So you know that if, one trustee happens to retire, they already have a backup plan. So it shouldn't be regarded by age, but as more of the person that you feel is really competent to take care of your child and their needs and be emotionally, feel for that child and want to take care of them and not just, push them away or be bothered by them. You want to be make sure they're in a good place and there is a firm and other people down the line to pick up, because it's not about age. Anybody can retire and say, I don't want to do this anymore. And then you want to make sure you have that backup.
Awesome. I'm just going to pause the recording now.
I put him